A government needs money. Nothing dramatic, no war, no crisis, just to function, pay salaries, keep hospitals open, fix roads. In front of them are two options: raise taxes or borrow money. Almost every modern government chooses to borrow, not because it's smarter, because it's quieter, and silence is powerful. Right now, governments owe more money than at any point in human history. In many countries, government debt is larger than the entire economy itself. And yet, nothing looks broken. That's the part that should bother you. If debt is dangerous, why does the system depend on it? And why does that choice quietly shape your job, your savings, and your future? Start with taxes. Taxes are loud. You feel them instantly. Your paycheck shrinks, prices rise, people get angry, news cycles explode, elections are lost. Debt doesn't do that. When a government borrows, nothing obvious happens the next day. No new deduction, no explanation letter, no protests. Life goes on. Debt lets governments spend now and argue later, often much later, sometimes after the decision makers are gone. That alone makes debt politically irresistible. But here's where it gets weird. Governments don't borrow like you do. They don't apply, they don't prove income, they don't get rejected. They issue bonds, basically IOUs, and the world rushes to buy them. Banks, pension funds, insurance companies, foreign governments. Not because governments are great with money, but because government debt is treated as the safest object in the financial system. Not safe as in never fails, safe as in if this fails, everything else fails first. Government bonds sit under your retirement fund, your mortgage rate, your bank's balance sheet, so the system protects them. Now, the math. If a government raises $1 trillion through taxes, it pulls money out of the economy. Less spending, slower growth, immediate pain. If it raises $1 trillion through debt, it injects money. The bond buyer pays cash, the government spends it. That money circulates. Debt looks like growth. Taxes look like punishment. Short-term, debt always wins. But debt comes with interest, and governments don't pay it once. They roll debt over. Old debt is replaced with new debt. Promises stacked on promises. Eventually, interest itself becomes one of the biggest expenses in the budget, sometimes bigger than schools, bigger than healthcare. No politician campaigns on higher interest payments. So how do they manage it? Not with taxes, that's too visible. They use inflation. Inflation is the quiet tax. Prices rise, savings lose value, wages lag. Debt stays fixed in name but shrinks in real terms. If a government owes money in its own currency, inflation makes that debt easier to live with. You pay, but no one sends you a bill. This is why governments tolerate inflation more than they admit. Not chaos, just enough. Enough to reduce the weight of past promises. There's a dark irony here. Citizens are told to save, avoid debt, plan responsibly. Meanwhile, the system works best when governments borrow endlessly and money slowly loses value. That contradiction isn't a mistake, it's the design. Zoom out. Debt makes governments sensitive to interest rates. A small increase can blow up the budget. So central banks step in. They lower rates, they buy government bonds, they promise stability. Not just for markets, for governments. Interest rates don't just affect loans and mortgages, they affect political survival. Low rates mean flexibility. High rates mean hard choices. So postponement becomes policy. Over time, debt stops being an emergency tool. It becomes normal. Budgets assume borrowing, markets assume rollover, voters assume nothing really breaks. Until it does. The ending is never dramatic at first. Growth slows, public services thin out, young people pay more for less, wealth concentrates. Not because someone flipped a switch, because debt compounds quietly. And this is where it hits you. Debt doesn't ask your permission, but it claims your future income. It limits what governments can do in the next crisis. It shapes how much risk the system can absorb. And eventually, when inflation isn't enough, it becomes visible again. The real question isn't whether debt is good or bad, it's how long a system built on borrowing time can keep working before time asks to be paid back.